Well, away from infrastructure now, despite the prevailing economic woes facing Nigeria's economy, the Central Bank of Nigeria and at its first Monetary Policy Committee meeting for this year decided to increase the monetary policy rate benchmark, also known as the interest rate, from 16.5% to 17.5%. Now, in a bid to further tackle rising inflation, leaving all parameters unchanged. And this is the first interest rate hike in 2023, and it suggests that the Apex Bank is continuing with its hawkish rate policy started in 2022. Now, you recall that the CBN had raised interest rates by a cumulative 500 basis points last year in the bid to tame the rising inflation rates in the country. Now, the development no doubt came as a surprise to many analysts who believe that the MPC will retain its monetary policy stance in order to sustain stability in that market, or the entire market. Well, let's talk about this. And I'm being joined via Zoom by the right person to discuss this. He is the chief economist at B. Adedikpe Associates Limited. It's Dr. Biodun Adedikpe. Dr. Adedikpe, thank you so much. It's good to see you in 2023.
Thank you very much, Tolu, for having me. It's a pleasure being here.
Yes.
I'm looking forward to the conversation.
All right. Well, my regular question would have been, what were you expecting for the outcome of that first meeting? But already now we've seen that there is an increase in rates. But was that what you were expecting, considering the deceleration we saw with regards to inflation for the month of December? Some say that didn't really mean a lot, so the central bank just had to stay with a hawkish move. What is your reaction to this?
Well, my reaction is very simple and straightforward. I was not expecting central bank to increase the monetary policy rate for a number of reasons that are not, let me say they are a little bit divergent from what the Monetary Policy Committee based their decision on. Not so much also about the little tempering of the inflation rate, but to ask questions about even the decisions about raising the rates by 500 basis points, as you mentioned, in the whole of 2022, and then coming to where we are. And for me, looking at the pattern of a structure of our inflation rate in Nigeria, I'm not too sure I've seen any strong evidence of correlation or covariance between the monetary policy rate and the rate of inflation directly, in the sense that it works the other way around in Nigeria. The monetary policy rate, you must understand, is a policy rate, it's a signal rate, so to say. It means if the central bank moves the dial up, the signal to the banks is to also uptick their own lending rate, which means cost of lending, on the flip side of it, cost of borrowing for the borrowers will go higher. If cost of borrowing goes higher, by all means, that impacts the cost of the business. And of course, naturally also, in an environment where most consumers are price takers, it means the end result, which is the selling price of commodities, will also go up. And that feeds straight into the rate of inflation that we purportedly want to control, which means in essence that actually each time you move interest rate up in Nigeria, it ends up in raising the general prices of commodities, which is what we measure in economics as the rate of inflation. So that is my own interpretation of it. So, and if you look at data as well, that is what data will tell you. Which brings us back to the real fundamental. And that fundamental is the fact that if this increase is designed to tame inflation, the question then will be, what are the major drivers of inflation in Nigeria? What is the relationship between core inflation and food inflation? So if food inflation is the major element, then it means raising the MPR in order to fight inflation. If you cannot connect that to food inflation, it will be just a policy that at the end of the day will not have the expected effect. And that is why I think, to start with, I was not expecting central bank to increase the rate. At the very extreme, I expected that they will maintain 16.5. So, but even at that, it also leads to another issue. And that issue of whether what they did simply was the textbook response to inflation rate, or what had been suggested in economic management, especially since about 2010, with the global financial crisis, that monetary policy, most especially, has to become pragmatic. And that means you don't follow textbook. You equally don't follow what every other reserve or central bank around the world is doing. You have to give more attention to the structure of your own economy and the peculiarities of its dynamics.
Very good way to start. And I think I reason with you, Dr. Adedipe. We need to consider your environment before you make some sort of decision. But let's talk about the money in the vaults of the central bank, which leading to the Naira redesign. The central bank governor mentioned this and said that this money out is affecting the implementation, or in his words, the efficacy of monetary policy. So we need to get all of those monies into the vaults so that they could, I don't know, you could explain to us what really is the positive if the central bank gets all of these monies into their vaults and, this new redesign thing is becoming an issue. What is your reaction to this, and how many of these new notes have you seen at the moment?
Okay, very good question, very contemporary issue. Now, to start with, the redesign of the Naira, I would say, is a step in the right direction for obvious reasons. I mean, typically, central reserve banks want to ensure they redesign the currency within short intervals to ensure, first and foremost, that they reduce or even short the window for counterfeiting of the currency. That is one. But more especially for us in Nigeria, so much money outside the banking vaults. And that, of course, has a big role to play also in the inflationary pressures that we are feeling here in Nigeria. Now, that on the one side. The other side to it is we can now begin to stretch it. Okay, what do we use so much cash for? What is the nature of what is happening now? How does that connect to insecurity and the rest of it? But the primary thing really, which I agree with, in the argument of the CBN governor and the MPC, that if there is so much money outside of the banking system, it compromises the efficacy of monetary policy. That is given. But it means that whichever monetary policy tools you roll out there may not likely achieve their ultimate purpose, because so much money outside there can actually make a mess of those tools and their application. Now, that on the one side, but the implementation, why Naira Redesign for me is a step in the right direction, but in my own view, we have not executed it the way it's supposed to be done. Now, in executing it, as much as we want so much money outside the banking system to come in, but I also believe that it will be an avenue to prevent money that is illegal from being brought into the system and laundered in that process. Yes, to that extent, is also good, because whatever is an influence to the banking system now will definitely attract the attention of those watching, and therefore have to report to the government agencies in charge of that, NFIU in particular. Now, given that, it means we expect so much money to come in, but recognizing also that we cannot change overnight the structure of our transacting business in Nigeria, which is that mostly economic activities in Nigeria are cash-driven. That's the reality. So it is then difficult to translate almost immediately from a cash-driven economy into a cashless one. So it's something that has to be done over time. This is a good window to bring in all those monies into the system and therefore cut out whatever money is illegal and cannot be converted. But at the same time, the CBN should ensure we have sufficient currencies to replace what is required to prosecute legal commercial transactions. Whenever you implement a currency redesign and it begins to hamper commerce, that by all means will also affect the economy at the end of the day. Because it means that ordinary economic activities that should be funded in the course of the flow of transactions will get stymied. And that becomes a major challenge for the economy in terms of growth and obviously development. And don't forget also that a good number of not only businesses, MSMEs, we now even talk about nano enterprises. That's the one-man person. Okay, when you take nano, you take small, you take medium-scale enterprises, they are in large numbers, 90-something% of registered businesses in Nigeria. When you also look at our population, you ask yourself, bottom of the pyramid, as we call them, most of these entities and individuals, they transact in cash. So to that extent, therefore, we must also bear in mind that a good percentage of the cash that comes in must actually be released back into the system. And then we upscale the encouragement of those economic agents to go on the digital platforms of financial institutions rather than use cash to do their businesses. It's not something we can force at a go. So, and that is why, in my own view, execution is where the real problem is. The volume of cash released to the banks, unfortunately, I don't have the figures, and then the volume of cash the banks can push back into the system to sustain commercial activities. That is where I think the real constraint is at the present moment.
Indeed. Well, Dr. Nidikpe, let's look at the perennial fuel scarcity also that we've seen, and of course, hike in energy prices. We know what's happening with diesel, aviation fuel, hike in flight tickets, airfares, and all of this. So when will all of this start to impact on inflationary figures? Or do you think that we'll sustain that slight deceleration witnessed in December? Are we going to carry that on as we move on in January? What are you thinking around that space?
I'm happy you raised this issue because it's something that I have argued about over years, maybe I should say decades now, okay? That we glibly talk about removing oil subsidy in Nigeria. We hardly look at the effects of that on the cost of living on the one hand and the cost of doing business on the other hand. Now, in the early years, we were talking about subsidy. We're still refining petroleum products locally here, the domestic economy. Then we got ourselves to a point where 100% of refined petroleum products that we consume is imported. So now, to that extent, there are some factors in there that immediately build into the pump head price of refined products. Number one is the cost of the underlying, material itself, which is the crude oil. That is number one. Secondly, there's a cost embedded in exporting it because it has to be transported. Now, when it is refined wherever it is, you also buy at a price that includes the profit margin of the refining entity. Then you also transport and bring the refined products back. So all of that process already has built-in costs that ordinarily would have been avoided if you refined locally. So in the milieu also, you have to deal with the exchange value of your currency. So in that kind of arrangement, anytime the Naira loses value against its major trading currencies, whatever subsidy you claim to have received will also creep back on your plate. That's one. Now, secondly, we have an unproductive pricing template as far as I'm concerned. Anytime you have a pricing template that has already upfront built-in demurrage, that tells me you have built-in inefficiency into the process of delivery of refined products and also distributing them locally. You have already built it in. So in which case, you are not even encouraging efficiency in that process. What I always say is this: anything you are dealing with in life, if you want to get it to the level of efficiency that will help your economy, you must develop a process view. Now, if you look at the process view of what we are experiencing today, and that is the real issue before us, now there is fuel scarcity. The question should be, what is the process involved? From placing an order, to getting it delivered, to clearing it, to distributing. So if you look at the process, just to mention those four, ends to it, how effectively have we managed that to ensure that there is no break? It's like talking about the ball not dropping through the cracks, okay? So it means something somewhere along that process we didn't get right, and that's why we have scarcity. All right, so we are not talking about not having money to pay for the imported refined products. It's about the products are there, but the distribution is not working well. So what exactly is the reason? And I also expect to help the economy. Somebody in the government should be talking to Nigerians about it. That we have looked at this. This is where the problem is, and these are the actions we are taking to address the problem. Now, that is the process of managing confidence. Economy is going to a recession, and they come out of it in recovery by the way you manage confidence, either of businesses or individuals within that space. And that is something I don't think we are getting right at the present moment. We need to improve on that. So if we now look at how prices have gone up, look, Tolu, as far as I'm concerned, the prices of refined products, diesel, fuel, and whatever, they've already filtered its rate of inflation. And if the situation now is sustained throughout February, and I don't pray that it will be sustained also to February, then we haven't seen the end of inflation. In which case, inflationary pressures will again spike, because you cannot prevent someone selling from pricing into his product whatever it is costing him to produce or bring it to the consumer. So in which case, if we want to check the inflationary pressures we are experiencing now, government needs to do something, in fact, make it a kind of emergency situation that must be dealt with. And then the one that has become more or less endemic in our inflation, which was why I said I don't fully agree with the fact of increasing MPR to deal with inflation as an effective tool in Nigeria, and that is food inflation. That also must be addressed. So two major things here to address to break the back of inflation in Nigeria: food inflation, and then, of course, refined petroleum products. That is my own take on this.
Great stuff. Now, Doc, before I let you go, we've talked about the implication of this rate. Of course, it's going to impact lending rates and all of that. But can you also tell us how investors will see us this time with this kind of rates, and also maybe around the stock market, what it means for the market, this increase?
All right. Now, this is a challenge for the capital market on the one hand, and I will explain very quickly how that flows through. Now, MPR goes up, lending rates will go up. In that case, those who fund financial institutions, whether you want to call them depositors or those who put their money in their investment products, whichever way you look at it, now they also will begin to ask for higher rates for their funds, in which case funds purchased by financial institutions will become more expensive to them. And when that happens, the only way they can sustain their margins will be to raise their own lending rate as well. Okay? So in which case, funds will become more expensive generally for the financial institutions that buy them as deposits or investments, and then for them also selling the product that they are selling. They sell money. That's the nature of their business. They buy and sell money. So the money they sell will also become more expensive. If that is the case, then it means companies that have to borrow inevitably to drive their business will have to still borrow, but borrow more expensive. And ordinarily, that will pass on to their customers. Now, where I'm going is this. The link between the money market and the capital market is simply this. If the rate of return I get on my fund placed in a money market product is going higher because the financial institutions are responding to higher MPR, then it means I will not look more in the direction of the capital market. Because traditionally, there's always been that flow in between them. Once the money market rates go down, investors often move more to the capital market. So the implication of this then is that we may not see retail investors push more money in the capital market to start with. Now, when you talk also about fixed, income securities, unless the rates also tick up, if the rates tick up there, it means more investment will also flow in that direction. And that will, of course, bring problems for, some other securities within the market. That's the way it plays out. Usually, rates go up in the money market, then it becomes more attractive than the capital market. Once rates go down there, more investors to the capital market. So what I see here is that we may see the capital market soften a little in response to this increase in the MPR.
Well, it's a good way to live it. It's always interesting and educating speaking with you. I've been talking to Dr. Abiodun Adedikpe, Chief Economist at B. Adedikpe Associates Limited. Thank you so much for your time on the show. We sincerely appreciate your contributions.
Thank you for having me.